Hello there, good evening and welcome to Business Focus with me, Michael Obodu. Coming up tonight, Governor of the Bank of Ghana, Dr. Johnson Esiama, chairs his inaugural Monetary Policy Committee meetings today to review developments in the economy. Ahead, we'll bring you details of his speech at the official opening of the committee's deliberations today. Also ahead in tonight's program, there is an emerging trend of customer misunderstanding of the role of banks in Ghana's Eurobond issuance, with some customers threatening banks of lawsuits for haircuts suffered. We'll be speaking to the CEO of the Ghana Association of Banks, John Ehua, who will be joining. Thank you so much for joining us. Before we delve into the topics for today, we'll bring you highlights of how the Treasury bill market has been faring over the last couple of days. Has made a case for Monetary Policy Committee to make its deliberations transparent to enable the public better appreciate the committee's policy rate decisions. He spoke at the opening of his inaugural MPC meetings, which commenced today, the 123rd edition since its inception.
As we begin today's deliberations, let me reflect briefly on two institutional areas which I believe we can further strengthen going forward. And that's to do with the transparency of our decision-making process and also the communication of our forward-looking guidance as a committee. Colleagues, there's a growing sense in public commentary, and I'm sure the media here will confirm that the MPC decisions that we take, that these are taken behind closed doors without clear data-driven reasoning. This is the impression out there. And so therefore, to counter this, as chairman, colleagues, I'm proposing that we implement mechanisms to make the committee's decision factors more accessible. We need to explain the issues better to the public, whether this means publishing the voting outcomes of members or enhancing the narrative content of our policy statements. Similarly, colleagues, we need to work on simplifying the way we present our forecasts so that the public and market participants can better understand the underlying policy story. These changes, colleagues, in my view, will strengthen our credibility and will deepen trust in the policy framework. Now, colleagues, turning on the macroeconomic context in which we are meeting today, while inflation is easing, I'm sure you have gone through your blue books, it remains uncomfortably high, and I must emphasize the word uncomfortably. Remains high at over 23%, and progress has been slow, particularly on a month-on-month basis. For instance, structural drivers of food inflation remain persistent. The external environment, colleagues, is another area which, though currently supportive, is becoming increasingly volatile. We've seen a strong trade surplus, and we've seen some solid reserve buildup, as the data in the Blue Book will show, and these on the back of gold exports and remittance flows. But colleagues, we also see a possible escalation in global tariff wars. We also see rising geopolitical tensions, and we see a weakening in Chinese demand, which could shift the dynamics. These global factors could also have spillover effects on inflation going forward, capital flows, and could also affect exchange rate stability going forward. Domestically, colleagues, the 2024 fiscal outing, as you've seen in the data, has been expansionary, with the deficit exceeding program targets. We have seen encouraging signs of consolidation for the first 2 months in 2025, But even with that, questions remain as to whether current measures are adequate to anchor expectations and or satisfy upcoming IMF program reviews. Colleagues, financial conditions are evolving quickly, as we will see in our discussions. Liquidity in the system has increased. Commercial banks have raised concerns about the CRR framework, the dynamic CRR framework I have come to meet. And we must carefully assess its macro financial implications, especially with respect to inflation, with respect to foreign exchange demand, and with respect to credit growth. While the private sector credit is recovering in nominal terms, real credit growth remains modest. Colleagues, banks are still cautious, and NPL levels remain a concern. Meanwhile, our microfinance and rural banking sectors are stagnating, although showing some signs of stability. We need to get along with the recapitalization and regulatory reforms to preserve confidence in that area. We must also acknowledge that some of today's challenges, as we may be aware, stem from earlier monetary and fiscal policy missteps, particularly loose fiscal policy during periods of macro stress, the weak monetary fiscal consolidation, and delays in key structural reforms in the recent past. These contributed to elevated inflation, impaired policy transmission, and a loss of credibility. Colleagues, it is essential, therefore, that we reflect on these issues going forward, and not to assign blame, but to strengthen our institutions and avoid repeating our past mistakes. Colleagues, there are also deeper structural issues which we must not lose sight of. For example, the underinvestment when it comes to agriculture, the persistent exchange rate misalignments that we contend with, and the need to deepen domestic financial markets, particularly after the DDEP and its impacts. Of course, these are outside the scope of our interest rate decision this week, but they will certainly shape the broader monetary policy landscape over the medium term. In short, colleagues, we are facing a convergence of a number of risks. And to give you examples, we have stubborn inflation, we have elevated liquidity, we have soft real interest rates, we have a fragile fiscal recovery, and we have growing external uncertainty. But at the same time, colleagues, we also have some buffers. We have strong reserves, as you see in the data. We have improving sentiment, and then the credibility of our policy framework, if we can strengthen it, will all guide us into our future. Our task over the next few days, therefore, colleagues, is to weigh these developments rigorously and to reach a policy stance that reinforces the disinflation path without undermining, and let me emphasize, without undermining the recovery or destabilizing market expectations. I want to trust that our discussions will be candid. In the next 3 days, our discussions will be evidence-based, and those will be guided by our shared mandate of maintaining price stability and supporting sustainable growth. With these reflections, ladies and gentlemen, I now formally declare the 123rd meeting of the Monetary Policy Committee open.
So here the Governor of the Bank of Ghana, Dr. Johnson Isiama, there in his inaugural MPC meeting. And just a quick recap of some of the things he has been speaking about. He spoke on basically 8 thematic areas. First off, transparency in key lending rate decisions. He underscored the need to explain the issues better to the public, whether this means publishing the voting outcomes of members or enhancing the narrative content of the policy statement. He also spoke about inflationary concerns, that while inflation is easing, it remains uncomfortably high at 23%, and progress has been slow, particularly on a month-on-month basis. And these are some of the issues that have come up, especially as government is cutting the T-bill rate. How much of a big deal is that when the inflation rates are still quite high? And it's a good thing Johnny Hua is here with us. He'll be explaining what this really means for the banking industry. Then he spoke about global economic risk, fiscal deficit and IMF concerns, private sector credit and banking sector caution, rural and microfinance sector challenges, structural economic weakness, and finding the right balance in policy to basically govern all of this. So I have in studio with me CEO of the Ghana Association of Banks, Johnny Hua. We've also been joined by Dr. Eric Boakye Yadom. He's a financial economist with the University of Professional Studies, Accra. Gentlemen, thank you so much for your time.
Thank you, Michael.
Okay, so I almost called you Doc again.
It's okay. I mean, you can give it to me, but I don't have the document for it.
Maybe we have to talk to Dr. Machuna. All right, so your initial thoughts. You've heard the governor speak. He's raised a lot of concerns in the industry and the likes. But what do you make of his inaugural speech?
I think the governor is saying all the good things, the things that as banks we would like a governor to be saying. And what I take very critically from what he said is around the transparency. As banks, much as we are dealing with the public, you need the public to also believe that whatever you are saying is also exactly what is in the public domain. But the point is, we are having a situation where things happen and banks get blamed for things we have not done. And it's important that we as banks take that responsibility and get the public to understand what our role is. And I like exactly what he said about getting transparency into the banking arena. Yeah.
Okay, Doc, what about you?
Yes, I think I will agree with my colleague here. And what we've lacked previous regime, will trace back to 2012 is transparency. And the Bank of Ghana, in some cases, has been reactive instead of being proactive and ensuring that the right thing is done. So we are hopeful that the new governor will be more proactive in terms of ensuring corporate governance is strengthened in the banking sector, and the monitoring and the checks. We shouldn't wait for things to go bad before we react to it, like the fire service approach.
Yeah.
You wait, there's fire, go and put the fire off, then you go and park the car until the next fire occurs. So I think we are hopeful that we'll be more proactive.
All right, Mr. Hua, so he spoke about rural and microfinance sector challenges. Now, he says that our microfinance and rural banking sectors are stagnating. We need to move forward with recapitalization and regulatory reforms to preserve confidence. What do you make of this?
We always, as a country, we've been talking about what's the name? Financial inclusion. Yeah. Getting everybody involved in financial. And you cannot undertake proper financial inclusion without having the rural folks in there. So we don't know his plans yet and what his strategy yet is towards the rural folks. But the point is, as banks, we are investing significantly in getting all these, all the arena in terms of when you talk about the entire economy, talking about every agent. Yeah, you understand, agents of economy, getting us all involved. We are doing that as banks, and we want customers to, or not just customers, our clients to also get involved. Because when you're talking about financial inclusion, you want every agent to be involved. And as banks, we are in the villages, we are everywhere, we are investing in digital transformation. And we want the bank, the customers to also get interested, that we want to also be part of this. As I speak with you, I'm the chairman of CFLE, Financial Illiteracy Education Ghana.
Okay.
In Ghana here. What are we doing? In this April coming, we are going to educate everybody. We are going schools, secondaries, wherever, to get our people educated. Because when you talk about financial education, it's not literacy. It's not about you being educated. It is about what kind of knowledge do you have about the financial decisions that you are taking.
Okay.
So we are going to the professors, we are going to the accountants, we are going to the bankers, we are going to the teachers, we are going to the masons, we are going to everybody, because we need everybody to be financially literate, so that as a country, that is the only way as a country we will know that we have moved forward.
Okay, so now to your sector proper now. The MPC is meeting. We should expect an announcement by next week, hopefully. Are you expecting the rate to go down, and by how much?
That's a tough one. You know, we have a very big negative yield in the country now. Treasury bill is at 15. You have policy rate at 20. You said it yourself, 27. We have a GRR at 28. You have a lending rate around 30. There's a huge gap we have to close. What I say is, whilst the rate as it is now is good for the country, it's good. Government of Ghana is able to borrow at a very relatively good rate. But if it goes on for a long time, it's going to create a significant problem. The problem it's going to create is you are a rational consumer, right? So if you have to put your money in treasury bill and it's going to give you 15%, and you have to borrow at 28%, banks are borrowing from Bank of Ghana at, let's say, upwards of 20s, and you have this at 15. There will be a shift. So the shift is what, as a country, we have to work on. That how do we close this shift?
Well, you are part of working on
No, but the point is, now, as a Bank of Ghana, if you are sitting in Bank of Ghana, why is the rate dropping that much? It means that there is more demand over supply. And if you have that situation, there is excess liquidity, right? What do Bank of Ghana do? We have to take that excess liquidity from the system.
Yeah.
And how do they do that? By issuing instruments, the money operations. So we are moving the burden from the government to the central bank. And the central bank, when they are issuing these kind of currencies, instruments, is significantly higher than what the treasury bill is now. Okay. To date, treasury bill has 15. OMO, which is OP market operations, the Bank of Ghana operations, is at 27. So why are you shifting? You are shifting the cost from government to Bank of Ghana. And then Bank of Ghana will declare a loss. And then the same country, you will come back and say, why is the central bank declaring a loss? So whilst it's good, the things that are causing the central bank, particularly to keep the rate where it is, we need to work on it, which is inflation.
True, but at least we've heard the government say that it will cautiously return to the bonds market. And I'm sure that will help mop up some of the excess liquidity that you've raised concerns about. But you as banks are also players in this. Help us understand what the strategy is from Ghana Association of Banks to mop up the excess liquidity. If you give out more loans, some of the money will channel through there, wouldn't it?
No, banks are lending. Banks are lending, but the thing is, banks lend within an ecosystem. Where we are now, where as a country, your MPL is around 20%. If you had money and every city you lend, you are almost going to lose every city 20 pesos. Would you lend? You will not. So we have to all contribute to the solution. So it is it's about an economy. It's a situation. It's an environment. All of us have a role in creating that environment, a good environment. I'm sure you have some friends who may not be even be speaking to you now because you gave them some 1,000 Ghana or 2,000 Ghana, and they're not calling you anymore. It's the same people who come to the bank. So we want to lend. The banks want to lend. The issue is, how do you lend and get your money back? Because when we lend, it's your money in the bank, we are lending. It's your money in the bank, we are lending. It's my money in the bank, we are lending.
Yeah.
How do we lend and get that money back? And that is what all of us should be interested in.
Well, at least the conditions that pertain to your NPLs of last year are seeing some improvements this year. Some marginal improvement.
Not much.
So at least there's some light at the end of the tunnel.
But not much. Not much.
Well, at least we take any claim of hope, or you don't think so? Anyway, I'll come to you, Doc. Doc, what do you make of all of this that's happening from an economic perspective? First off, on the NPLs, on the NPR, what viable options do you see?
Yeah, so the ecosystem is not complete, and they are not communicating. That's why we see these discrepancies. Number one, in determining our reference rate, the three key components, as we know, is the interbank rate, the policy rate, and the treasury bill rate. Now, I was telling Mr. Wu a while ago that consistently, the treasury bill rate from January 6th has been falling. And if we look at the rate of fall from January to February, it has fallen around 30%.
Yeah.
Then from January to date, it has fallen around 44%. But the reference rate has hovered around 28%. And the lending rate, as he rightly mentioned, is around 30%. Now, we know that the treasury bill rate constitutes about 40% in determining the reference rate. So if for nothing, if the treasury bill rate is coming down, which the reference rate is determined monthly, and banks based on it to determine their lending rate. So if it is falling, we should have expected a marginal fall, at least either 1% or something in the reference rate. But it has been stationed at that around the 29.7 or 28%. What it means is that the fall in the treasury bill rate is somehow artificial. And it's not really communicating to the other ecosystem that will make it real in the economy. So we are expecting that as they are preparing to announce the policy rate, they should come out with a rate which is realistic, not for political reasons. Because the idea that the government is trying is that let's make the treasury bill fall, let's make it less attractive, so that banks will end up lending to businesses. But we cannot force, just like he's mentioning, if NPL is high, banks are skeptical in lending to private sector, so they will need to find other means to either hold on to their money, holding on to your money for the value to fall sometimes is better than lending and not receiving it. So you cannot force bank necessarily by making treasury bills less attractive. So we should be cautious in terms of trying to achieve a certain drive or a certain policy. because banks will not necessarily lend to businesses because the treasury bill rate is less attractive. So they may be finding other means to put their money, which probably we may talk about it later. Yeah. But generally, I think that the way the treasury bill is falling is quite artificial and does not really reflect the situation we have in the economy. And the government should also be cautious that you have some debt commitment, that are coming, and you have treasury bill issuance timetable. That you are going to raise these bills or to finance your debt obligations. If these rates consistently fall, now we have seen about 45% under subscription in the recent one. Now, if this continues, you will not be able to generate enough money to pay those debts or the coupons that are on it. We are hoping, probably government is thinking about something else in terms of financing this debt. But if you look at the timetable and you keep missing your target, you may not be able to raise sufficient funds. So we shouldn't create an artificial economy. We should make sure that the system or the ecosystem is well orchestrated to reflect the reality on the market.
But this is a government that has already set a revenue target of about 20% increase from last year. So maybe they are planning to fall on some of the domestic revenues that they are raising through the GRA to cater for the shortfalls that you're talking about. I remember also that this is a government that has come under a very tight fiscal space. And this is one of the ways that they can create some room to be able to sort of manage the debt levels. Remember that T-bill rate at 28% is a very expensive rate to be paying as a government, especially if you want to manage your debts. Now they are cut it to 15% so they can open up space for the bonds market. We know that the bonds market have been literally dead since the DEP conversation. So don't you think that this is just another approach that may pinch us a bit at the moment, but still free up the economy, open up the economy a bit more? Because very soon the bonds market, if it picks up, would also be another option for people like John Ehua and his association to put in some money there as against the T-bills, give government some more longer credits that makes things kind of restart to some extent. John, quickly.
Yeah. When the minister talked about reopening the bond market, I had a goosebump.
Good one or bad one?
I don't know. The point is, where are we going as a country? Where do we want to go? And we've signed contract. We don't have to forget that we have signed contract with the bondholders or the bill holders who signed on to that document that gave us that reprieve. What message are we sending to them? So when we met the minister, we were very firm that even if you have to issue any new instruments, those instruments should not be in a position of higher priority over the one you already have.
In terms of payment?
In terms of everything, because by IFRS, if you issue an instrument right now at 15%, you are going to put the old instruments underwater. By a mark-to-market mechanism, you are going to kill the banks. You understand? So we are working with them. We want all the government, as we want in the event. We all want to go to the secondary market. We want to build that market. The banks want to help with that market, but it has to be well structured.
Very passionate on it right there. We're going for a quick commercial break. When we come back, we'll delve deeper into other topics lined up for you. Stay tuned. This is Business Focus. for the haircut suffered. We had similar misunderstandings from some customers during the domestic debt exchange program, as some thought the bonds were the bank's proprietary product. In studio with me is the Chief Executive Officer of the Ghana Association of Banks, John Ehua. Thank you for your time. So now, what really is happening with this whole misunderstanding and this Eurobond issue?
Yeah, it's an unfortunate situation, the way we are having it now. The problem is, as banks, we have done everything we have to do, educating our customers, the fact that we are just agents when we are in the issuance of, whether you are talking about domestic bonds or even Eurobonds. But because of the domestic bond, there was no haircut per se. It was that reduction of interest. The Eurobond is rather bringing out this issue where customers feel they are feeling the real hit of a reduction of their investment. And we've been monitoring, and you've seen evidence of some banks getting customers coming in and asking whether they have like a recourse to us. But unfortunately, banks are just agents. We are not issuers. The issuer of the bond is the government of Ghana. We are not holders and selling to our customers, so to speak. But the Eurobond, the way it happened, the way we, when customers are purchasing instruments such as the Eurobond, we need to also read all the documents that come with it. The Eurobonds were issued directly with prospectus. And in that thing, there was a clear clause that if a significant number of holders agree to a certain condition, everybody else is binded. And we are all bound to go with it. It's got a collective action clause. And the collective action clause, you need about 75% of the holders to say, we agree to this. And it includes default conditions. And the government of Ghana defaulted. So they sat and said, all right, we are not happy with what is happening, but for these conditions, we are okay. Whatever they agreed, every holder of the bond will now have to abide by. So you cannot, by buying that instrument, now go to your bank and say you want a different, because once the 75% agrees, in that clause, it says you cannot make anybody whole. You can't make anybody better. If I take 40 for $1, you can't make anybody 50 for the dollar. And that is exactly what has happened. And those who did not take part, they lost a lot. They lost the participation fee. They lost the even the accrued interest and on the bond. They lost all the benefits of it. And what happened was that if you did not participate, we have to pay you out. How do we pay you? On the day of settlement, whatever the price is the price you get. And most of them got 42 cents for the dollar. And that is why they are coming back and they want to get the bank. But the banks play no role in that.
It just shows that there was some knowledge deficit or information deficit in all of this. What would be your assessment of, for instance, the previous government's dissemination of information to ensure that the bondholders don't suffer this much?
You can't blame the previous government or anybody. I mean, it's we, all of us. The banks, perhaps we have a role to play. Not perhaps, we actually have a role to play. If somebody is buying an instrument from you, you have a responsibility to educate the person. These are the obligations. these are the benefits, these are the outcomes. As for the bank, the government is looking for money. So they have just thrown out a paper out there. You have to take the decision whether you want to take part in that paper or you don't. So as banks, as we do every time, we are educating our customers. Every time, unfortunately, when we give that paper to customers, how many of us go through that, the long list of the things that you have to read, the things that you need. And unfortunately, if you don't go, you cannot come back and say that the bank is the one creating that situation of maybe you have lost money. You cannot blame the bank. Because we have done everything. Everything. All we have to do is to educate you, let you understand. And once you understand, that's it.
It's a good thing you said everybody is involved in it. So we can send you an invoice so that we run ads for you to clear the and better inform the people.
No. I'll do that every time. But the truth is, people must know that when you go to a bank, the bank has a duty to educate you.
Yeah. And
you also have to take the education seriously. When the bank gives you that paper, don't just go away. Read it. It's your duty to read it,
Okay, fair point. Doc, would you want to have a bite at that? It's quite sad that people have lost.
Yes, no, in this situation, there's little we can do. We just hope that they don't also go seeking legal counsel, then you lose money by going to get a lawyer.
Even further.
So let's try and salvage whatever has left. It's painful, but from what we know, what has been explained by Mr. Ewa, I think the inability or not getting time to read the prospectus well affected many people. So we shouldn't go spending more money seeking legal.
You lose money.
Yes. Even more. Because basically what you're saying that there's really no end to this.
There's no recourse to the banks. Yeah. There's no recourse.
Rather unfortunate. So we'll move now to another topic. Now, a string of devastating fires have swept through markets in Ghana, leaving traders and shop owners reeling. The latest incident occurred on March 21 at the Blue Light Arena in Edum, Kumasi, where a commercial hub housing shops selling mobile phones, accessories, jewelry, clothing, and second-hand goods was ravaged by flames. This fire follows a series of similar incidents in January 2025, including a blaze at the Katamanto market in Accra on January 2, which destroyed several stalls and left traders displaced. Okay, so we'll just walk you through what has been happening with market fires since the start of the year. So first was January 2, 2025, Katamanto Market in Accra. The extent of damage of 100 shops were destroyed, affecting thousands of traders. Goods that were destroyed were worth over millions of cedis. I understand about 60% of the market was destroyed in this particular fire. So to the next one. So the next fire incident that we recorded. 2 days later, there was the Kwadasu Wood Market fire in Kumasi. Also, this time in Kumasi, the extent of damage, majority of equipment and large quantity of wood were destroyed, leading to significant financial loss for traders and businesses. So that's Kwadasu fire. That's the second one recorded this year. The next one on the list. It's interesting that we've had these fires happening. And then the next one went all the way up north, Tamale Timber Market, January 6th. I believe that was 2 days later. So we had every 2 days we had a fire in the first week of January. In January 12 again, there's another fire in Techiman. It appears interesting. So now over 700 shops were affected in this case. A lot of property destroyed. The deaths running into millions of cedis. And the next one was the one we just experienced a few days ago. That's the Doom fire that we know that over 300 shops have been affected and significant losses have been recorded. We have joining us via Zoom, via phone, the Director of Communications for the Ghana Union of Traders Associations. Thank you so much for your time. These are quite sad times for you as traders in the country, not so?
Very much so. Let me say good evening to your viewers and your listeners. It's been a great concern to the business community. If you look at the loss, if we're going to quantify the loss, it's going to be something great. But the issue here is that most of our markets are not local government markets. You can talk about few local government markets. When you talk of Kaneshi, Medina, there are few local government markets. Most of the markets are customary markets, which means the markets were done by its indigents. Individuals put some two containers, 2 tables there, and then they start trading. But here, the challenge we have here, government intervention is very limited. If the people are trading, I think government, there must be a public-private partnership in our market setups. Once upon a time, I remember in UK, there was a no man's land somewhere where people were just parking their cars. One day they just got up and the government came and wrote no parking sign. Before you could say that, he had created a parking zone and he was taking tolls. Look at a constituency like Abosokai. It was done by one man. When you look at the history of Abosokai, it was done by one person who was trading in a drinking bar. He converted a drinking spot into a pepper shop, and it became 2, became 3, and it went on. But let's ask ourselves, what is government intervention? What is government participation in our market areas? So that's why we see that the structures of our market is not conducive for marketing. So we believe that if the indigenous have come out to create a market, government should show interest in the market areas so that we can put the necessary equipment and gadgets. For a huge constituency like Abosokai, we don't even have a police post in the whole market setting. So security-wise, we are not secure. So I think these are some of the difficulties we are facing. When we look at when you quantify the loss, it's more than even government intervening and putting projects in place. So we are looking for areas where government can partner the private sector so we come out with a proper structured market area. So far, look at Kantamanto. It's not well structured. But the fear of the unknown, if we have these fire outbreaks and government want to intervene and build the market, but the fear is that would the space go back to the original owners? That's most of the challenges we face when government wants to come in and restructure the market spaces. Because at the end of putting it back, you see that the real owners don't get the spaces again. So it's a concern to the business community and it's a concern to Guta in general that most of our markets are not well structured.
Yeah. So, Paddy, I know that for you as Guta, over the last couple of years, you've been working on putting together some form of micro insurance for your members. How far with that?
Yeah, it's a concern. That is, you see, and then our concern is where the insurance company, they are not even ready to come to the market space because they said the security, the cost of security is very high. So most times you see that most of the insurance companies are not ready to participate in our market. So the market is not well structured and the fear of the loss is so high. Therefore, they are not interested in coming to our market area to insure. But we're saying that if we can partner the insurance company, then you insure some of our shops. It's not always every time that market gets burned. But in any case, when something of that happens, the insurance company can come into our aid. But we don't see those things happening. So we want to invite the insurance company to partner Guta. What can we do to insure our shops and our wells so that in case of any fire outbreak, we can have some relief and respite? So it's a concern. And we as Guta, we're also working out something to see how best we can get about 2 or 3 insurance companies to partner them in this area. Because most of the insurance companies are not really interested when it comes to the market area because they see the market are not well structured and therefore the security aspect is very high there and then the fear of the loss, yes.
Now, Joseph, I know a lot of your members have borrowed money from the banks to run their businesses and now they've lost it to fire. It's a good thing we have John Ewa in studio to tell us how he also feels about all of this and what the way forward really is in mitigating these losses.
Yes, I think
Paddy, that was for Mr. Ewa.
No, it's a problem. As banks, whatever risk happens in the country has an element to do with us. And it was refreshing hearing him around getting some insurance and other risk mitigation programs. But the point is, when we are talking about the kind of risk that we have as a country in terms of the credit risk, all these incidents are part of it. You have the banks, you have this kind of fires and incidents that happen that banks have no recourse. You have the courts, you have Land Commission, you have EPA, Environmental Protection Agency. They are all part of the credit creation arena. In countries where we, as a country, we want to compare ourselves with, all these institutions are functioning properly. But what we have in Ghana, we don't. We don't have anything. A bank lends and the bank takes the 100% of the risk. There is no proper insurance. If you lend to an agric company, there's no agric insurance.
Yeah.
There is nothing. And when you are done, when you are done in terms of there's risk in the and you go to the court.
Okay.
And of course, you go to the court.
Yeah.
They also have a problem because you cannot recover quickly from the court
I was
system.
hoping at this point you would say maybe you are giving some waivers to the
No,
I understand where you are going to, but
there's nothing to give away. To be honest with you, there is much to take from the system. But
fair point.
There's not a lot.
Fair point. So, Doc, maybe just quickly, 30 seconds from you, then we'll wrap up.
Yeah, so generally, I think the problem, all of us, we know that our markets are not well structured. And until we do something about it to have a well-structured bank, we will keep coming back to this issue. And the cost to the government, I mean, it's so huge. And we are expecting this to also increase non-performing loans for the banks. So we have to find a solution, sit around the table, and find a lasting solution to some of these things.
Gentlemen, thank you so much for your time. Earlier on phone was the Director of Communications for the Ghana Union of Traders Association, Joseph Paddy. I had in studio with me John Ehua. He is the CEO of the Ghana Association of Banks. And then we had also a financial economist, Dr. Egbache Yadom from the University of Professional Studies, Accra. I am Michael Ubodu, and that brings us an end to today's edition of Business Focus here on TV3. For more business stories, please visit our website, s3news.com/business. Later on News 360 will bring you more updates from the world of business. Thank you for watching. Catch you same time next week, and as always, please.
Ghana coming out again, the same squad. For the ball, he's got it! Throw it down, King!
Sports Station now shows on Mondays at 9 p.m. on TV.